Just got done editing this interview. You guys are going to love it. Before I do that, though, I want you to know that I'm going to be in the comments for the next 30 minutes or so answering your questions. If there's additional questions you want me to ask the CEO next time I interview them, leave them below. Or if you're just loving the data points I get CEOs to share, click the thumbs up button below. That's your way of telling me you're loving this stuff, and I'll get you more of it. Additionally, again, I'll be in the comments answering any questions you have. All right, for 30 minutes. Enjoy the interview. Hello, everyone. My guest today is Pedro Alves. He's building a company called Ople, which makes AI easy and valuable. He's been in the industry for 18 years. Some of that time was in academia and some in the industry as a data scientist. He's been struggling, or he's seen the struggle that companies face when trying to get a return on investment with AI, and that is why he created Ople. All right, Pedro, you ready to take us to the top?
Yes, absolutely.
All right. So what does Pedro do, and are you guys a pure play SaaS model?
Yes. So like you said, I've been my whole career doing AI and trying to get companies to actually get a return on investment besides just PR, which is how most companies see AI today. And yeah, our company is software, right? So it's software that enables a user that's not very technical, a business end user, an analyst, to build models that up to today would take, a team of PhDs to actually build.
And is it pure play SaaS, or is it a lot of consulting as well?
No consulting.
Okay, so all SaaS,
Yeah.
recurring fees.
Yeah.
Okay, and give me a general sense of what you're working with here, right? So on average, what's a company or customer going to pay you per year to use the technology?
So we try to build in a way that incentivizes people to build more models to do more with AI. So initially, investors really wanted us to charge per model built, per project done. And that way, I think it goes back to the whole thinking, the whole mentality of companies going, okay, we have these 5 projects, we only have money for 2, which ones do we choose? And we didn't want that. So the idea is if we charge per user and say, how many people are going to be using the software, a simple, type of user license, then they can build as many models and build as many projects as they want. So most companies are going to be in a 6-figure yearly engagement with us just because of the number of people they have. You got a few that are going to be in the 5-figure, and then we have a couple that are in the low 7-figure range yearly. But those are a lot of users, bigger companies.
Yep. Okay, so you're charging per users, like per seat. Is there any usage-based upsell?
No, we want to incentivize the behavior of the more you do with AI, the better for your company, the better it is for us. Okay, so charge per seat, have some less than 6 figures, some more than 6 figures, but it sounds like a sweet spot might be called 100, 200 grand a year to use the technology. Yeah, for a lot of companies, that's going to be the size given their team.
So the reason I asked that question is let's then go into your sweet spot. So if I am paying you 100 grand per year to use your technology, how many people are probably on my team? How many seats am I probably paying for?
So in that range, that's going to be in the 3 to 6 person team. So that's still, company could be a medium-sized company, but you have a small little team of analysts or business developers. And that's going to be roughly given that range.
Yep. Is there anything else you upsell against besides number of seats? Any feature-based upselling?
So we are starting to talk to some customers about some beta products that we haven't really advertised on the website. Things to do with unsupervised learning and a couple of other technologies that are really new out there. And so those are things that would be charged separately. They're separate products within the platform, if you will.
Mm-hmm. No, that obviously makes sense, especially as a company matures. So what is that? I'm curious, history here. What does it look like? When did you launch the company?
Close to 3 years ago. It was in the beginning of 2017, so getting close to 3 years.
Okay, and how between when you wrote the first line of code to your first dollar of revenue, how much cash did you sink into the MVP?
So the MVP we got to very quickly. I had been thinking about this for a good 5 years before starting the company. So when we hit the ground running officially, I had done a lot of the legwork, right? So we started officially in the beginning of February, and we had a big demo day with an accelerator at I think it was the last day of March or the very beginning of April. So it was like 2.5 months, and we had, granted what it looked like back then and what it looks like today, there's a big difference, 3 people working on it for 2.5 months versus today. But yes, technically we had that initial demo that we could do with a fully functional piece of software within 3 months.
And so cash, I always like to get MVP cost, right? So you're talking like 100 grand into the platform pre-revenue, or 300 grand or $1 million?
So I'm not measuring to revenue. I'm measuring to like you said, the MVP of the software, right? The first
That's my question, Pedro. How much cash did you sink into the platform building it before your first dollar of revenue?
Before the first dollar revenue, so that first dollar of revenue was still in the first year. So I want to say less than $1 million. It was in the six figures because the first check we got was in the first year, by summer probably. So I want to say, let's ballpark it around 500,000.
And most of that was developed, these 3 developer salaries, folks like things like that.
Yeah, that was the biggest cost. We had a few extra costs, cloud costs. We had conferences that we went to, but the majority of it ended up being with salaries and then a little bit of hiring. Towards the end of the 5 months, we started actually growing the team a little bit.
Yep. So where did you get this $500,000 pre-revenue? I mean, are you super rich? You just funded it yourself, or you raised capital?
No, I raised capital. So I started off with a $300,000 check from an accelerator group in Atlanta. And then after...
What'd they take for the 300? It's like a YC model, like 100, 150 for 7% or what?
Yeah, it was a percentage based. Okay. The interesting thing was one of my advisors told me that initial check was too small to basically, you want to get a check that gets you long enough that you can get the next check, right? And I had a fun conversation with him where I called him and he said, look, I've been thinking about it for 1 month. I finally going to give you an opinion. He hadn't yet. And he said, I think you shouldn't take it. You need to wait till you get a bigger check because you're going to run out of money before you get your next investor to put money into you. And as he finished this whole thing, and I said, I actually called you to tell you I just signed the contract and I wanted to celebrate with you on the phone. And we had a fantastic conversation because it was still super valuable because of that advice, right? From day one, I knew I was going to run out of money. I trusted his advice and I said, okay, I'm going to start raising today, day one. And he was pretty much right.
What was your burn at that time? So you raised $300,000. How much what were your total expenses at the time?
It fluctuated a lot because we kept cutting salaries in order to make it last. So that first, we didn't raise again until I want to say end of May or June. So it lasted about 6 months. That $300K.
Okay, so you're burning about $50,000 a month.
Yeah, I mean, it lasted us about 6 months. That sounds about right.
Yeah. Okay, good. And then, so how much total today have you raised for the company?
About 15 million.
Okay, 1.5 or 5.0?
1.5.
1.5. Okay. Yeah. So you got on a funding track. You obviously keep raising. When was the last round?
So we raised Series A last year at the end of the year.
Okay. And that was for how much?
That was an $8 million A round.
8 Series A, end of 2018. Okay. And why was 8 million the right amount to raise for you at the time?
It was just doing the math of, how many people we need to build the product to the stage that we need to get the product to so that we are selling at a faster pace, we're differentiated enough. And then obviously trying to measure the runway of when do we think we can raise Series B, right? What's the right valuation for Series B? How much ARR we need and what we need to have with the product. So it was just getting all these measurements of when we think we can raise B, how much money we need to get to that point. And, that's the math.
So what is what is the answer there? So 8 million was buying you about how many months of runway, would you say?
So the idea is always to be in the 12 to 18 month range, and then adjusting as you see, as you see the burn, right? As you see what's happening to ARR, and then having the pliability to adjust later if you need to get a little more or, cut costs, etc. For us, it was the interesting conversation around when is the company ready for Series B and what are the measurements to get there. Right now, because the space of machine learning and AI is so hot, some of the math is not the normal math, even for Silicon Valley with overinflated valuations. I think AI is its own beast right now. So there's always the conversation of, do you assume that by the time you're going to raise B, the hype is still going to be there and those valuations are going to be like that? Or
what do you think you have to get past to get a competitive Series B done in terms of revenue? How big do you think you have to grow on this 8 million?
That's exactly the point of this conversation. So if we were in the normal space, I think to get to a good valuation, we would need to be in the 4 to 8 million ARR, maybe 5 to 8, to get the valuation that makes sense. I think given the space that we're in and the exits that I've seen, Small. I'm talking about, single digit ARR, how much companies are being sold for, their valuations. I think it's more along the lines of 1.5 to 4 as opposed to 4 to 8 to get to those valuations. But we're trying to be conservative, right? And we're trying to assume, let's not count on the hype being there when we raise B, and let's try to hit the numbers that are closer to normal, unhyped, if you will, valuations. So we're going to try to hit, those numbers that are more in line with other industries. And if the hype is there, we get an even bigger valuation. That's even better, right?
So what ARR, I guess, would you consider a massive win if you crossed it by the end of this year? We got 3 months left in the year. What's the target?
So our target for raising B is by the end of next year.
So you want to be north of like $3 or $4 million in ARR by the end of next year?
By the end of next year, yes, I want to be north of 4.
Okay, and what will you finish this year at?
So this year, I think it's going to be around 1.
Okay, around 1. And what'd you finish last year at?
Last year, so prior to this year, the numbers were, I would say, inconsequential. I think we hit 6 figures barely.
Okay. So 2018, you did about, call it $100,000 in revenue. This year, you'll break $1 million.
2018, yeah.
Yep. Okay, good. So, obviously, nice growth there. Now, you said you raise $8 million. Obviously, you're managing for 12 to 18 months of burn. 8 million divided by 12 is about $600,000 a month in terms of total burn is what you could cover. Is that about what you're burning right now?
That's a little over our burn. And like I said, it's 12 to 18 months. So that's our burn is not that high. It's a little, it's close, but it's not that high.
So you're talking more like 400 grand, something like that?
Yeah, it fluctuates around there.
Can you live with 400 grand a month in burn? Like, can you sleep well at night, or does it make you nervous?
It's a very high number. It's
high is relative, though.
What?
High is relative.
Oh, absolutely. For the space that we're in, I think it's not exorbitant. I think if you look at people that we're trying to compete with and the estimated burn that they've had from the information I have, we're actually under, I would say. The A round series from a lot of the competitors are higher. They require a lot of more money to get to the same ARR that we're trying to get. Mm-hmm. So in that sense, as insane as it sounds to say that 400 a month is tame, I think the amount of work that we're doing, the product that we're getting out there for the amount of money spent, I think we're certainly ahead of the industry.
And how many customers are you serving today?
Today, customers that we're fully engaged with, either in pilot or above, it's about a dozen. Okay. Post-pilot, full, then we're talking about a handful.
Yeah. If you're past $1 million or you're about to break $1 million in a run rate, that's $83,000 a month. Customers are paying on average about $8,000 a month or $100,000 a year. That would be about 10 to 12 customers paying that, right? So that's how you get your $1 million run rate.
If we get to that point, and that's the hope.
Yeah.
There's still quite a few contracts for us to sign that are in the pipeline, but not signed yet for us. What
are you at right now? Like last month, what was revenue? If it's not 83 grand.
So as of last month, let's see, we have, I can't, I don't know off the top of my head what the monthly is for last month, but a lot of it, we're basically this whole year, right, is end heavy, right? Almost everything is happening in Q4.
Yeah, but like you can give me some sort of like function, right? I mean, $1 million a year is what you said you'd finish this year at, which means you're doing at least $83,000 a month. 83 grand times 12 is $1 million run rate, right? So if you're not there yet, to some degree how far away you are. Are you only doing like 40, 50 grand a month right now, or are you really close?
Yeah, so we have about, I would say, 55% or 60% of the way to go. But with the pipeline that we have and finishing the pilots, we think we can hit it.
So you're doing about $40,000 a month right now in revenue across 12 customers, paying about $4,000 a month on average.
The number, the dozen, the 12, that's people that are not full customers yet. It includes people that are in pilots.
How many full customers?
A handful.
Okay, like how many? Like 5, 6?
3.
Okay, 3. That's good. Well, that's helpful because what I was getting at is either you have less customers or your ACV is much lower. So what is actually the case is you've got less customers paying a higher ACV, but you have a lot of potential pilots that are going to close here potentially in the next quarter.
That's the hope, yeah.
Yeah. So you're doing, call it 30, 40 grand a month right now in revenue. You have about 10 in pilots, and you hope with closing some of these pilots before the end of the year, you get up to 80 grand a month, 90 grand a month, something like that.
Yeah.
Good. I love that. How are you getting these customers?
A lot of it is conferences right now. We're starting to turn on the marketing machine just now, so we're ramping up on that. So inbound is not as high as we want it to be. So we have a few good relationships with VCs here in the Bay Area that actually provide us a lot of introductions to companies. So that's one. Plug and Play is one of those. They've been phenomenal at getting us meetings with customers.
Were they the accelerator that put in 300 grand?
No, they were not the initial accelerator. They came in later.
Okay.
But they've been really, really helpful with getting customers. And then a lot of conferences and talks that I give, and then people reach out saying, "Oh, this sounds interesting. What do you guys do? What are you selling?" So it's still, small scale, if you will, right? Introductions, meetings, and conferences. That is not obviously scalable, and that's why we're starting to invest into the marketing.
How many people are on the team today?
So we have about 22 people in the Bay Area and about 14 people outside the country.
All full-time?
Yeah.
36 then full-time. How many engineers?
The majority, right? So let's see. We have about 12, 14, 10. I would say about 24 out of the 36.
Okay, and how many are quota-carrying sales reps?
We have two.
Two. Okay, so you're just trying to figure out how to scale that.
Yeah, I mean, I think we're still before, scale, right? We're not there yet. We're still trying to figure out the formula, how to sell, right? All the things that you need to understand to figure out what a sales process is like, how long it takes to sell, how to navigate a company to get a close, right? I think we're not there yet. So we're still not at the point that we want to scale, because in order to scale, we need to have the answers to all those questions, right?
Yep. Instead of going out and raising more equity capital, because you're going to keep getting diluted, right? If you do that, would you ever consider using debt?
I looked into it. I talked to a couple companies that do that. I think that there's actually a few other interesting options that I might look at, right? So there's now the potential to do, it's not a full IPO, right? But there's a new regulation that allows you to raise capital through non-certified investors, right?
Yeah, you're talking Reg A, Reg B, Reg D.
Exactly. So I have a friend that actually did that and successfully raised $50 million. But he did caution me that it is a lot of work and a lot of time spent doing just that.
A lot of legal.
Yeah, absolutely. There's family offices, which ends up being the same thing as a VC, but the difference is that they're a little, they're going to be a little more generous, I think, with the percentages. That's what I've seen in the past.
But still, they're going to take equity. My point is, would you ever use debt, which is non-dilutive, to drive growth of the company?
I don't think that the speed that we need to grow at is that just doesn't, the math doesn't add up.
Mm-hmm. You need more cash than what any debt provider would give you.
Yeah, unless we were trying to just coast, which is not what we're trying to do, then we would go that route. But then the potential for the exit would be significantly lower, right? You increase the bottom, you decrease the risk by doing that. But you decrease the potential for growth.
Yeah. I mean, I get it. You are, though. I mean, you know, there's a lot of founders that get into a lot of trouble by raising ahead of revenue. I would put you in that category. I mean, your ARR to funding ratio is like 16x, right? You're not actually, it's more like 32x, right? $500,000 in ARR on 16 raised. I mean, the company, you could argue, should already be bigger than it currently is if you've deployed $16 million to grow it.
Oh, we absolutely. We haven't deployed all that money, right? We still have quite a bit of cash in bank.
Okay, like most of your Series A is still, most of the $8 million still in the bank? We
still have a good amount of that, yes.
Okay.
And of the full $50 million we've raised so far.
Yeah.
The point that I was going to say is, like I said, in the space that we're in, like if you look at AI, there's the last two exits that I saw were in the range of, the companies had between 3 and 5 ARR and sold for between $300 and $400 million.
Mm-hmm. Tell me about two companies on the flip side that raised as much and went out of business, had no exit.
That's a good question. So let's see. The companies that I know that would be close to being in that position, that didn't happen yet. So
yeah, nobody. It has happened. Just nobody talks about it. So you don't know.
No. I mean, I think it's going to happen. They need a little more time for that to happen. I can see them going the path that you're saying.
No. My point is, though, founders do what you just did, which is you use the hyper successful comps and you never look at, or many times they're not even aware of the 100 companies that died to get those two winners that you just quoted.
Right. Okay. Fair enough. The examples that I know of the failures that you're asking for, a lot of them are going to be they've raised a ton less money. They fail much sooner. So they actually never got the chance to deploy nearly that much money because they failed when they were still 2, 3 people. They raised maybe, less than $1 million. And then there's dozens and dozens of failures there. The examples, I thought you were asking of examples of companies that actually raised at least double-digit millions and then they failed. And for those, I think if we wait a year, we're going to have a couple of those stories because I can see already the companies that are massively overinflated on the valuation and the amount raised in comparison to the revenue. I'm talking about between 50 and 300x if you're doing that math that you did. And then when you start getting to those numbers of like 200-300x, I don't think they can dig themselves out of that hole.
Mm-hmm. Well, I mean, you raised $8 million, right? If you gave up, let's say aggressively 20% of the company, right? That's putting you at a $40 million pre-money valuation, right? 40 million divided by $500,000 in ARR is an 80x multiple. You could argue you are one of the overinflated AI companies that has raised a ton of money relative to your ARR.
I think the difference is that at the A round, the expectation for revenue in some industries is not the same. Most A round companies have zero revenue, so then it's an infinity multiple.
Well,
right?
That's not true.
No, it is. It absolutely is.
No, I can tell you that is not true. I have interviewed a significant portion of AI companies that have raised Series A, and
in the Valley?
majority. Well, you can keep adding qualifiers and say in the Valley, in my town, in my building, right, to narrow it down. But I'm telling you, that is not an excuse. There are the majority of Series A companies.
No, I'm not making
revenue.
an excuse. I'm just saying and I agree with you. The qualifier of the Valley is, I think that the point of view that investors take, because I spoke to investors from Boston, Austin, Atlanta, Chicago, New York. And the reason I made the qualifier is that the approach to investing that most of these other cities have is actually very different. They're looking at ARR much sooner. And so the potential for growth for the company is different. They're not looking to get a unicorn, and they're looking to get more reasonable growth, more reasonable numbers when it comes to businesses. And so you're correct. If you look at the whole country at A round for the whole geography, yes, a lot of them, if not the majority, do have revenue in the A round. But that's a different beast, and I think they're looking for something different. And the types of companies that they grow into they become different types of companies.
Yeah, well, we'll see what happens. I mean, just for context, you're burning in a month more than what your total revenue annual run rate is right now. I think we'll leave it at that and move on and wrap. I hope you drive growth, by the way. I'm not rooting against you, but I just want to call a spade a spade. You've raised a lot of money relative to the revenue you have. Now, you still have a lot of that in the bank, which is fine.
No, absolutely. It's scary, and it's something that we're working on fixing, every single day. I guess I wouldn't use the word fixing, growing into.
Yeah, you got to grow into it. That's fine.
Yeah.
All right, let's wrap up here with the famous 5. Quick answers if you can. Number 1, favorite business book.
Favorite business book, Dr. Seuss. All the places you'll go. I think the analogies you can make between that book and what a startup life is are amazing.
Number 2, is there a CEO you're following or studying?
I like Ben Horowitz, and now, he's now CEO. More of an investor, right? That's most of his role, but he's done that before. But I really like how he views the importance of cultures in companies.
Number 3, what's your favorite online tool for building your company?
Favorite online tool? I like the Google suite.
Number 4, how many hours of sleep do you get every night?
Probably about 5.
Okay, and what's your situation? Married, single, kids?
Married, kids.
How many kiddos?
4.
Wow, you're a busy guy. How old are you?
I'm 37.
37. Last question. What do you wish your 20-year-old self knew?
Exactly what I did know. Because you mess with the past, you change the future. And I like where I am today. So I certainly don't want to change. If I change my past self, I might not be here today.
Ople.ai, guys, making AI easier to understand. They've got about 3 customers paying $14,000 a month, doing about $40,000 a month right now in revenue, with eyes on $1 million in terms of run rate, with about 10 pilots right now. We'll see if they close. Founded the company in 2017. Today, they've raised about $15 million total, burning, call it $400,000-ish per month. That's net burn. 36 people on the team, 24 engineers, 2 folks are in the sales space. If they look to continue to scale, potentially do another raise here in the upcoming quarters. Pedro, we're rooting for you, man. Good luck. Thanks for taking us to the top.
All right. Thank you.
These CEOs rarely give these kinds of interviews. I hit them hard, I get the data, and I want to do it more. So if you want to get more of this stuff, make sure you subscribe up here. And then additionally, go check out one of my other CEO interviews right now.